We recently published an article about operating leverage, why it's important, why you actually need to know what operating leverage is, and what to look out for when companies shift, when their operating leverage shifts. And we're going to examine this through the lens of what Tesla is doing right now, because they're proposing a big shift in business operations.
Spoiler alert, this is not just relevant to Tesla as we go through this. If Tesla does embark on all of the changes it wants to make, this is going to have an effect on the rest of the semiconductor industry supply chain and potentially affect some companies that have been benefiting from positive operating leverage, especially in the last year or so. Quick reminder, if you want access to these write-ups on operating leverage, make sure you join Semi Insider, available over on our website, chipstockinvestor.com. Seriously, check it out. We really appreciate it if you do. We've been told by our users that we have added a tremendous amount of value the last couple of years since we launched that service.
You can find it only at chipstockinvestor.com, and make sure while you're at it, hit the subscribe button if you would like to watch our videos some more.
Back in January, we did a video talking about ECUs, or electronic control units. There are a lot of these companies that provide these, two of the leaders being Nvidia and Qualcomm, but they are suppliers to the automotive industry. A lot of what Tesla does is not just encroaching on this market, but obviously Tesla isn't a third-party supplier. They do it all for themselves.
And as you can probably imagine, the work on self-driving car hardware has at least some overlap with robotics. And that's what we're going to be focusing on a little bit today, because Tesla has announced that they're going to be spending more of their efforts on their Optimus robot.
So in addition to competing with the third-party suppliers of ECUs in the semiconductor industry, we can also file Tesla under end-market robotic companies as well.
And because of this, Tesla has admitted that it's going to need a lot of supply chain work with robotics, autonomous vehicles, and then also they have their energy grid segment as well. And in order to shore up that supply chain, they're going to be needing to spend some extra cash. $20 billion in capital expenditures expected for 2026, and that number is probably going to grow based on what we'll talk about here in just a little bit with their expansion into developing their own fab.
Let's break that CapEx down. A big chunk of that $20 billion is going to come from the first line that we have highlighted here, other model production. That is the long-running Model S and Model X high-end Tesla vehicles. No surprise here, production of those has been winding down. They are going to convert that manufacturing line over to Optimus. And so retooling that manufacturing line is going to cost a lot of money.
We have a video from the second generation model of the Optimus. I guess we can expect that there's going to be a lot of improvements, maybe more squats, maybe more eggs scrambled. We'll see.
Dishwashers precariously unloaded.
It sounds like we need one. But is this going to be just an expensive toy for the wealthy? I'm not sure.
Well, they've been promised these things would cost less than the cost of a new car. Who knows what that means?
New cars are like outrageously expensive.
So that is what is included in the 2026 CapEx of $20 billion. That's the outlook. What is not included is some of the other supply chain work that will go around Optimus humanoid robots. But not just that, also data centers and also supporting the Model 3 and Model Y and robotaxi, robocar, cybercar, whatever that's going to end up getting called. Here's a quote from Musk on the Q4 earnings call. To sum this up, what do all of those things have in common? Cars, data centers, Optimus robot, they all need lots of semiconductors. And so TeraFab is what Tesla wants to build. They're going to have some more announcements on this perhaps later this year. They're doing some planning on it. And so that $20 billion in CapEx for 2026 does not include TeraFab spending. But Elon and company seem pretty intent on making this happen to secure supply of all these future projects. Plus, I imagine this thing, if it gets built, would also supply Elon's other companies as well, like XAI and SpaceX, which it sounds like will probably be merging later this year.
I guess ultimately what you're saying is 20 billion is just the tip of the iceberg in CapEx spending. This is definitely going to eat into the balance sheet. These are the figures for Tesla on an annual basis. In red, we have cash from operating activities, and in blue, capital expenditures. So for the year, cash came in 14.7 billion and capital expenditures only 8.5. So more than doubling it in the next year.
Tesla vehicles have hit a patch of no growth now for the last couple of years. So I don't think we can expect a big ramp up of cash from operating activities, which means Tesla is going to have to dip into that balance sheet. The good news here is they have lots of cash available to tap into to make that happen. So that's the good news. 44 billion in cash. Expect that to start getting used up in calendar year 2026 to start with the Optimus supply chain, and then later on, perhaps TeraFab.
The issue with all of this is that as it pertains to operating leverage, which was our thesis for this discussion to begin with, Tesla's going to be incurring a lot of new upfront capital outlays, fixed costs, as well as new variable costs, as Nick mentioned, with developing the Optimus this year and into the next. And all of that, of course, doesn't take into account this possible TeraFab, which will develop an entire array of new costs for Tesla.
And if Tesla vehicle sales aren't yet a positive operating leverage product, there's going to be a period of time where Tesla's cash outflows once again dip back into the negative, and we would expect the market to discount the stock accordingly until it gets some visibility on these things returning to positive cash flow expansion. All of this could be really fantastic long-term for Tesla if they pull it off. We certainly would not bet against Tesla being able to do it. It's done the impossible before, and much bigger company, more resources available to it today. We certainly wouldn't say they can't pull it off again. But that said, operating leverage for the time being, not at play for the company. And so maybe in the future, though, they will get some benefit from expanding these supply chains and bringing more supply in-house, including possibly memory chips, logic chips, advanced packaging, and so on and so forth. And perhaps also monetizing the semiconductor supply needs for XAI and or SpaceX.
Now, just because Tesla's now building out this supply chain for its own robotics market does not mean that there isn't already an existing supply chain for the robotics industry. And we've talked about this on a number of videos, and we've pointed out some other companies to consider over on Semi Insider, companies that make and design actuators and a type of actuator called a servo system. But let's talk about the existing supply chain briefly. What will happen if Tesla develops this complete supply chain from design to manufacture?
Long term, if they're successful in doing that and they scale up the sale of those new products, it could do wonders for Tesla's revenue. And of course, what you would be looking for over time is proof that they're getting higher cash flow from integrating all of that. Now, that doesn't mean Tesla would be a direct competitor to the semiconductor suppliers it currently sources product from, like Micron for memory or Nvidia for GPUs. But currently, some select businesses within the semiconductor supply chain, as we've pointed out recently, have been getting incredible pricing power because of the chip shortage. That is doing wonders for their positive operating leverage. But if Tesla is successful in providing its own source of products, that removes some of the demand off of the negotiating table for those companies, and could be one of many reasons why some of that current pricing power that's favoring them comes back down. Another way of putting this, as we often talk about it, companies that provide a commodity part or piece that is needed to make a total product versus companies that actually make the final product and wield control over their supply chain. There isn't really one that's better than the other. You should have a mix of all sorts of types of companies in your portfolio. But this is one item to be aware of as Tesla once again goes on the offensive here. Some of the semiconductor suppliers that have been benefiting from Tesla and XAI and SpaceX and a lot of other customers, these companies that make the actual final product are very interested in controlling their costs and are not going to sit around and just accept the higher pricing for forever. So just some risks for you to be aware of and why you should be constantly on the lookout for enhancing your portfolio for future events. Don't get blindsided when this suddenly becomes a thing in some years down the road.
If you're interested in learning a little bit more about the ECU companies, take a look at this video we did right here, top 3 autonomous driving and robotic stocks for 2026. See you over on Semi Insider. Check it out, chipstockinvestor.com.